Good morning, good afternoon, good evening, traders. I'm here again to discuss with you second part of market structure. I've discussed part one with you, where I explain the nature of formation of market structure as a whole. There, I explained to you that a market structure cannot come to being without formation of swing highs and swing low, without formation of support and resistance, without formation of waves, all right? And understanding how these waves, how these impulses, how these corrections, how these swings high, swings low, how this support, how this resistance join together, combine together. Understanding them is what makes you to understand market structure appropriately. And when you combine all this together, you'll be able to know if a market is trending or not trending. That was our conclusion in part one of understanding market structure. So in this video, on part two of understanding market structure, I will show you how to analyze each wave of the market structure. All right. There are two types of wave that will be explained in this video. These waves combine to form overall structure of the market. All right. We'll be looking at two waves, and those two waves, they are the ones that combine together to form the market structure. And what are those waves? You see the impulse wave and the corrective wave. So, but first, what do you mean by wave? When you hear wave, you're just coming into the market, you do not know anything about market structure except the part one that we did, and you're just hearing me talking of wave, 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 wave. Are we talking of something that drop on top of the ocean that is going up and down? Is that what we mean? Yes, if you think so, you will be correct. If you are familiar with dropping an object on the sea, you will see that as the forces that is pushing the sea up and down, as that forces continue to be, you will see that the object that is being dropped on the sea, that is floating, will also be dancing in line with the wave that is generated by the sea. And what is the behavior of that wave? The behavior is simple. There are times that the sea pushes the object up and followed by what? Down, up, down, up, down. So this is a natural phenomenon and also occur in the chart. You see, there are times that the chart goes up, at times it comes down. At times it goes up, at times it comes down. That is what is called waves. So now you have understood what is called waves, being nothing but a measure of how much price pushes to the upside or to the downside, either impulsively or correctively. Can you see? Impulsively, correctively. Impulsively, correctively. Is that okay now? So we want to see how far price is able to push to the upside and how far is able to correct. So, but do not be confused when you hear slangs or terminologies like correctively or impulsively. Okay, so these two terminologies will form the major part of our discussion in this series of understanding market structure part two. Okay, so referring to our first video of on understanding market structure part one, you learned that market structure occur when price develop repeatable support and resistance. All right, when market develop repeatable support and resistance, forming a higher high and higher low in an uptrend, and lower low and lower high in a downtrend. Can you see? When price is forming a repeatable pattern of support and resistance. Where is support? This is support. We treated it in our last series. This is resistance, resistance, support, resistance, support. resistance, support. Can you see? It's forming there is a consistent formation of higher highs, higher low, higher highs, higher low, higher highs, higher low. That is what forms a trend. Do you understand? You also learned in part 1 of understanding market structure that price also develop swing highs and swings low. Can you see? It swings high and swings low. So now, why breaking previous highs and previous low, price develop into two forms of nature. Do you see that this price now from here, as it's coming to this side, it has broken one top, one previous top. Where's the previous top? Here. It has broken into the upside. Okay? And then it now relaxes. So when price develop into breaking previous top or breaking previous low or relaxing after, forcefully breaking previous top or previous low, they now form two natures. There are two natures that form as a result. So that is where the idea of impulsive wave and corrective wave comes in. As this market, this wave, as it breaks the previous top here, it has formed an impulsive wave. And this one that is coming down here is forming a corrective wave. This is the one that forms when this particular price has a lot of momentum, a lot of energy to propel to the upside. Okay. So in that case, having had this basic background, what do then mean by impulse? When we say impulse, what is impulse? So impulse is the fast and sharp movement of price in the direction of the major trend. When I say a fast and sharp movement of price in the direction of the major trend, if you are just starting off as a newbie, as a new trader, you want to ask, where is the axis for price and where is the axis for time? In your basic secondary school understanding of graph, you were told that we always have two axes. If you study science, engineering, economics, you will know that every graph, every chart must necessarily have two axes. And our chart here in TradingView is not an exception. You are having a price chart as a vertical axis right here. Sorry, right here. Price chart is on the vertical axis. It's on the vertical axis. Do you see the axis at the right corner here? It's a vertical axis. That is the price chart. And then you have the horizontal chart is the time chart. Is the time axis rather, not chart, time axis. Look at it. Time axis is the horizontal, while the price here is the vertical. So whenever we are having an uptrend and price is going up very fast and very sharp, you can see that the rate at which is traveling in the direction of price is sharper and faster in this up move than the rate at which it's coming down. So this is what is called an impulse. An impulse, another characteristic of an impulse is its ability to penetrate previous resistance in an uptrend in order to form a higher high. This is a previous resistance. This move has the ability to penetrate this, break it to the upside to form a higher high before it will pull back. Okay, that is the definition of an impulse. So in an uptrend market, so impulse develop when price moves so fast as to break previous resistance to form a higher high. All right. So by the time you get to learn impulsive wave in detail, you will see how it develops, especially the number of pushes in the direction of the trend that is required before any major correction can happen. All right. When you are learning an impulse in a more detailed manner, you will see that this entire length can be an impulsive wave, as we will be seeing later. You understand? So remember that as soon as price break previous resistance in an uptrend, for instance, it can start to retrace at any level. It can start to retrace at any level. And I have been emphasizing this, especially to right the wrong for the breakout traders. Okay, breakout trader don't get it here, because of course, in an uptrend, every support provide an opportunity for buy. But breakout traders don't buy from this support because of the fear of possible continuation to the downside. Okay, they want to avoid that loss, so they allow a very strong push to the upside to start, and as soon as it breaks this previous resistance, that is when they get in for a buy here. It is late. You don't do that. The reason why you don't do that is that this market can either come here and turn, or can come here and turn and pull back. This also satisfies the rule of an impulse and a trend formation. Why? Because it has this level here, this structural level here has broken this level. So it has made a higher high. So if you are getting in here, and that is the same level that this market is required to pull back, what happens to your trade? You either go in drawdown or you lose. So that is why I always emphasize in any of my teaching that you must allow this push up to continue. Let it get to wherever it will get to, because there is no rule that defines where it must stop. And then from there, allow it to pull back to form, a reasonable level of correction before you can start another move to the upside. Okay, I think we should be wise right now. So for an uptrend, you need to allow the price to retrace or pull back before you can enter a buy trade. You must allow this market to pull back here before you can enter a buy trade. So this pulling back that I'm telling you to allow the market to pull back is what is called a correction. Is what is called a correction. So now, therefore, correction is the pulling back of price against its major direction. You remember when I was defining impulse, I told you that impulsive waves are those waves that develop when price move, in the direction of the what? Of the chart, in the direction of the move. In this case, where's the direction of the move? The direction of the move is to the upside. So if the direction of the move is to the upside, any move that is to the upside is usually going to be very fast and very sharp, because the move of the market is favoring the current move, the current wave. Do you understand? Now you see this move to the upside is going to be very sharp and fast because this market flow is to the upside. All right. So when we look at market structure, we usually want to allow a pullback. Want to allow a pullback. We want to see a pullback happening. Excuse me. If pullback does not happen, you don't have a market structure. I want you to know that, because when I was defining market structure for you in part 1, you can refer to part 1. All right. I was detailing how you get the swing high, the swings low, the support, the resistance, the impulse, the correction. All these are essential elements that form a market structure. All right. It is not only an impulse that forms a market structure, nor the correction that form a market structure. You must have all necessary ingredients that I described in that video. So usually when a pullback is happening in market structure, what is the amount? What's the reasonable, or what amount of pullback is considered as reasonable enough? There is no rule that sets the limit to pullback in any particular structure. But for me and any of my students, I recommend that a pullback to fib level 50 to 61.8% retracement of the previous impulse is satisfactory. It's just enough for us to look for continuation trade. But, well, wait a minute. Uh, who does not understand fib here? You know, there may be many new traders here who do not understand what fib mean. All right. I encourage you to go back to Google, go and Google fib, but I will describe it, briefly for you here. When you are having a market structure, developing into trends, all right. So you have, let's say you have a move here that goes this way. From here to here is a sharp move, which we call impulse. You want to see that this market can retrace to this level and move to the upside. Okay. It can also retrace to this level and move to the upside. Okay. It can also retrace to this level and move to the upside. Can you see? But how do we know when the level that this market will retrace to before it moves to the upside? Look at it. It can get here, upside, get here, upside, get here, upside. But what if it gets here and you take in a buy and it now push you down only to maintain this level? What happened? You have lost because you have put your stop loss here and it has taken you. What if you think it's going to be here and it is here? What do? So that is the essence of having a fib. A fib is just an acronym for Fibonacci. All right. So Fibonacci ratio is the ratio to which an expectation is put on a pullback before you continue to buy or sell a continuation in the direction of the major trend. All right. So in this case, we use this shape here. You see it here. See the fib retracement. Just click it, put it, drop it at the level of the start of the impulse. Take it to the end of the impulse. You now read. There are many levels. You have 38%, you have 50%, you have 61.8%, you have 78%. I don't use any of those. What I'm interested in is 50% retracement and what? And 61.8% retracement. This is the level I'm interested in. All right. Any retracement level that is not coming down to this level, I am not interested. I want it to come to this level because if it comes to this level, you notice that the distance between this, the level you are taking this buy and even the beginning of the impulse, the distance is not so much compared to what? To the move that you are going to catch to the upside. So it means that you are having a smaller risk and a bigger reward. It makes sense. That is why I encourage any of my students to consider application of fib at 0.5 to 0.618 fib retracement. Is that clear now? All right, so let's clear this out. Let's clear this out. Let's clear this out. Give us space. Clear this out. So we understand what fib is all about now. Okay. Now, at this stage, you need to know that impulse does not occur in a straight line. And also correction is not even as simple as you may think. You can see that I'm drawing the line, straight line like this. But when you get to the chart, it's not as simple as that. But this schematic I'm drawing for you, if you master it and understand it, for you to get it clearly on the chart will not be difficult. All right. So for instance, so when you look at any impulse within market structure, you must see a major swing highs and you must see a minor, you must see a major swing and you must see a minor swing. When I say a major swing, what do I mean? From here, from this level here, all right, let's say from this level here to this level here, this is a major swing from low to high, a major swing from low to high. And within the structure, you have minor swings again, because this impulsive wave here does not go in a straight line. It also have push, correction, push, like that. This correction will have its own. So you have structure inside structure or structure within structure. That is how market develop. You have this. Let's use this two. This one will come this way, come this way, come this way, come this way, come this way. This one will come this way, come this way, come this way, come this way, come this way. This one will go again. Can you see? The structure is forming within structure. So these are minor swings. This structure that is forming, minor structures here are minor swings, and you have the major swing. All right. So finally, in this series of market structure video, I will like to show you how the nature of impulse, in terms of the strength and the nature of the correction or pullback will determine how the continuation will be. I want to show you how the nature of the impulse that you get and the nature of correction that you get will determine the nature of the what? Of the continuation. For instance, if you have a push, a correction. Now, this push, let me do this push very well so that you understand what we are saying. You have a push, just one push, very strong, and then you have a correction here. You have a correction here. The correction is going like this. And at this stage, this correction is now developing like this. It's going to go this way. And by the time it goes this way, what does it tell you? Number one, you will notice something very clearly here that, of course, this is equal level. You see that this market has broken this level to the downside, thereby picking liquidity at this area, at this level, which is first, approval to this move to the upside. Another thing is that you can see the push to the upside is very strong. And can you see that it has satisfied 0.5 to 0.618 fib retracement? Can you see? So because it has gotten there, even tap it to the downside, this is very cool and great for us. So when you have these two confirmation, you can what? You can take this trade to the upside from here. You can take this trade to the upside. It's as simple as that. So before you take a buy trade in an uptrend, of course, you know that you have to buy after correction is over. After correction is over. So as it is here, this is the impulse, this is the correction. How do you know that this correction is over? Can you see as it's coming down? When it was at this level, it was not up to what? 50 to 61.8. It was not up to 50 to 61.8, and even if it's up to 50, for the mere fact that it's developing a corrective structure here, you don't get involved when a market is developing a corrective structure. You know that this corrective structure is going to break down to peak liquidity at demand for it to be able to move to the upside. So you'll be very careful at getting into the market here. Even when it breaks to 61.8, you are still very careful, only that you have to get set. In order to, you have to get set to get in for the buy trade so that you don't miss your entry at this level and then putting your stop loss below the impulse. Okay, so this is very critical to your understanding of entry. So you need to wait for price to have a well-developed consolidation. Look at it here. It's a well-developed consolidation. Can you see? You need to wait to see the market having a well-developed consolidation here, all right, and break down to grab liquidity at demand, and then you take your trade. Can you see? You can see well-developed consolidation. You have a breakdown to pick liquidity here, and as soon as this liquidity graph takes place here, you know that you are in an uptrend because you already have a previous impulsive move here. So as soon as you grab this liquidity here, what are you waiting for, guys? Pick your trade to the upside. One thing that is very essential, it's not part of market structure, but it will help you in your confirmation entry. You want to see whether you have O number area here. O number area here. What is O number area? Or psychological, number or sub-psychological number. If you see this level now, this level I've highlighted for you, you see that you have 0.8750 right here. This is a sub-psychological level. So this market can pick liquidity here and grab it and make a move to the upside. You also want to check at what session is this pulling down coming in. If you're having a liquidity, a consolidation here, and this market breaks down in London session, all right, and preparatory to New York, you know, the market is at this location. You know that if this pair is a pair that moves so fast in New York session, you should know that this big move is going to come in New York session. One, you have the impulse. Two, you have the correction. Three, it has corrected to the appropriate level. Four, it has peak liquidity at what? At sub-psychological level, price level of 0.8750. And five, confirmation. The fifth confirmation is what? We are entering a highly liquid and fluid what? Session, which is what? London stroke New York overlap. That overlap is capable of driving this liquidity. It's able to drive this volume from here to the upside. Is that okay now? So this is the way you need to look at market structure. This is the way you have to look at market structure. So by this, guys, with this uptrend analysis I've done for you, just apply the same techniques to a downtrend. It's as simple as that, guys. Apply the same techniques to a downtrend market. For instance, let's say you have a downtrend here, you have a downtrend, you have a push, you are expecting a correction, and if the correction is coming like this, and I'm getting to this stage, it's now forming a correction, a corrective structure. You expect that this corrective structure will break to the upside, tap liquidity here, here being up to 50 to 61.8% fib retracement, and looking at this area, you have psychological level of 0.9100. That's a whole number. From here, you don't hesitate. If this move to the upside is occurs in a London session, for instance, if you have a grab of liquidity right here, you have this consolidation happening here, and London push this market to the upside, necessarily, you see that this is a supply area. How do you know that this is supply area? Just go to this impulse, find out between here, between this level here, what is the nature of the candlestick that you have here. If my candlestick is if it's red to the downside and green to the upside, how many red do we see here? And how many green do we see here? If we have a big red to the downside here, it means that we have a supply zone here. It means that there was excess supply over demand here. And whenever there is excess supply over demand, price has no alternative scenario to follow other than to fall to the downside. This is how you trade appropriately. This is how you reason like the bank. This is how you apply wisdom. This is how you apply logic. And this is how you apply behavioral analysis to take appropriate trade in the market. I think you have been able to understand this approach right now to market analysis. I've tried to make it very simple. And I believe that all these I have discussed here are very relevant to your trading progress. Please don't hesitate to subscribe if you have not already done so. If you have subscribed, please like, share, and comment on the video so that it can be shown to many people. Also, don't forget to press notification bell, because each time I drop a content, you will definitely get the notification and be the first to see the video. So also let us know in the comment section if you have any topic you want me to do a video about. I'm very ready. I'm very ready to do it for you within next 3 days. I'm very ready to do it within 3 days. Just write your comments. write me there. Let me know the topic. I will definitely do it for you. So I see you next time. We are still going to have market structure part 3. This is part 2. We have done part 1. We are still going to have part 3, which somebody has requested. That one is going to be on reversal. How to deal with reversal. How do you take the top? How do you take the bottom? Situation where you don't need to take the top, you don't need to take the bottom, and all those stuff. We're going to treat it in part 3. So see you next. Bye bye. Peace.